really part of what happened last year is borrowers saying no to prices, not rates necessarily. And so I'm kind of excited about the spring selling season because I think we might actually, in certain markets, start to get true price discovery. But I do think we'll end the year down with like an aggregate price decline. And I'm
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The U.S. real estate market remains frozen. Transactions are at multi-decade lows, mortgage rates remain painfully high, and home prices are at near record levels of unaffordability. As we enter 2024, should we expect things to get better for housing or worse? For answers, we turn to mortgage lending expert and housing analyst Melody Wright. She's been busy visiting many of America's most popular housing markets to develop a true boots-on-the-ground understanding of where the trends are headed. Melody, thank you so much for joining us today.
Thank you, Adam, and thank you for having me.
Oh gosh, it's always a pleasure. Thank you for coming back on. Our last interview that we did a couple of months ago really was a blowout. I mean, folks really loved it, and they really appreciated your boots-on-the-ground intelligence that I just mentioned there in the intro of, flying to these markets, getting in your car, driving around. And, my big takeaway from that interview was that there's a lot of stuff going on that is not making its way into the official reporting systems on housing. So I know you were finding lots of inventory that actually was not in MLS, which was interesting because not only does that impact what consumers see when they're out there looking for a house, but it impacts the data that not just realtors, but housing analysts like yourself look at. And so a lot of what's being reported isn't taking into account the full picture. Very curious if that's still the case. Lots of questions I got for you here, including, if we have time at the end, maybe identifying some interesting behavior patterns that are beginning to emerge amongst transactors in real estate where, even though the market is frozen, like I said, people are creative and they're finding interesting ways to transact and kind of get around some of this stuff, or at least reduce the pain of the current economics here. So anyways, lots to talk about. You've been nodding your head as I've been saying all this, so good. I'm super excited with what you've got to say. To kick it off, can we just start at a very high level with this question? What's your current assessment of the U.S. housing market?
Well, so I think things are about to get a little interesting, Adam, especially in Florida. So, we saw those rate drops at the end of the year, and we're sort of kind of staying at the same place right now for the last week or so. But I think what those rate drops are going to do is actually bring out a lot more sellers who think it's a good time to list because they think that the demand's going to be out there. So it's very early. I do think there's going to be demand. And let me say that there's always demand due to, things outside of our control. But what's happened so far is that mortgage applications in the first couple of weeks were actually down, just in both in a seasonally adjusted and non-seasonally adjusted. This last week, they were up for refinance, which is not a sign of consumer health, because that means that a higher interest rate mortgage is a better option than, some of the debt that they're carrying.
Right.
But purchases were still down on a non-seasonally adjusted basis, 16% year over year. And as we know, last year wasn't great either. So these are pretty abysmal numbers. But, Yahoo Finance came out, I think today or yesterday, with an article that bidding wars are around the corner and we're about to, enter into the crazy market again.
And sorry to interrupt, but I just noticed right before getting on here with you that Zillow apparently increased its home price appreciation projections for 2024. They were at 0, I think, basically flat market predicted. And now I think they're saying like 3%, 3.4 or something like that. So yeah, seems like there's this optimism creeping into the analysts' viewpoint.
Yeah, it's wild. And even people I would have expected to be a little bit more sober about the move got real excited. I think maybe because that first move was just so fast and it dropped so quickly, and everybody thought, okay, we're going to just keep on going down, But I think that optimism is a little early. I think that's because people don't understand a lot of the stuff that you were talking about, Adam, that there's there's more going on under the surface than most people know. And so, but to me, this is when things are really about to get interesting because it might prove the narrative false, right? That even Fannie Mae has proved it false. They did a survey, they came back and said, you know what? We were wrong that the lock-in effect was having this outsized impact. It has some, but that's not really what homeowners were talking that much about. And so I thought that was very fascinating. But what's going on right now in Florida? So typically between December and January, you see really big drops in housing inventory. It's just a seasonal thing. The average is around 10%. So in Florida, that it has not happened. And in fact, you're just seeing some really kind of crazy increases. And so I think we're going to test the theory out there early about what these rate drops are going to do, what the behavior is. And I can say already that what we're seeing is a lot of price drops, especially in these oversaturated markets like Lakewood Ranch and some other Florida markets. And so, to me, as much as things are feeling very muddy from an economic perspective, I think we're all kind of looking ahead about is 24 going to be like 23 where everybody was wrong and we were all just, expecting certain things to happen, especially because of the election. We'll talk about that. But I think this could be very interesting to sort of prove out the fact that really part of what happened last year is borrowers saying no to prices, not rates necessarily. And so I'm kind of excited about the spring selling season because I think we might actually, in certain markets, start to get true price discovery. So, generally for the housing market, I don't think this is going to be, a banner year, put it that way. We're not going to go gangbusters again, but I do think there's going to be activity. I think there's going to be some up and down sort of moves, similar, sideways moves to what we saw last year. But I do think we'll end the year down with like an aggregate price decline. And I'm very different from most of the formal forecasts out there. But I really think if nothing else changes, that we will see price declines overall this year.
Okay. Well, that'll be interesting. That indeed happens. So on your latest Substack, you just issued an article titled Gale Force Wins.
Yes.
And in there, you basically said, if I'm remembering correctly, the most important thing about 2024 is going to be what was the most important thing in 2023, which is narrative. And you just mentioned it really briefly that maybe some data is coming out that is showing the narrative that was held in 2023 might not have been completely accurate. As you look to 2024, what do you expect the narrative to be? How do you expect it to evolve, if at all?
Well, I think it's going to be what Yahoo Finance just did. And I think, they're going to do everything in their power to kind of generate buzz about the recovery of the housing market. I mean, the builders were at an all-time high, even with sales down, and their revenues down and margins down. So I think it's going to be very similar in just pumping this false idea that, we're still in an inventory constrained environment. But with these rate drops and sort of the new builds, you should be able to get a good deal. But I think that the narrative will start to get challenged, especially if we start to see in Florida the kind of activity I expect in the spring. One of the reasons that the narrative sustained last year is because the builders don't have to record those sales concessions, and they essentially in the MLS. So we don't know for sure what those true prices were, and that's not reflected. And
Okay.
so, and then,
Is your
sorry, and Fannie
suspicion
Mae,
that they
go
were
ahead.
maybe more generous than are being discussed? Like maybe they're discounting even more aggressively than folks really expected just to be able to move inventory?
That could be, but let's say you bought a home for 400,000. They paid 25,000 on your closing costs. They paid your HOA fees of about 10,000 the first year, and they gave you a washer and dryer. Let's say that's $50,000 of concessions that nobody's taking off that top line price, and it gets recorded as a $400,000 sale. So essentially, you got a house for $350,000
Right.
versus 400,000, and that's not recorded. Now, excuse me, in the MLS, there's supposed to be a place where you do record those concessions. But Fannie Mae, in its letter to appraisers at the end of the year, said that they did a sample of 7.6 million comparables and found that 58% of those appraisals did not take into consideration those concessions. And so it is very likely, at least in 58% of transactions, that you have an inflated appraisal. And so, these are the types of things, all this is just sort of coming out, trickling out. And I think, there's going to be a lot of push against these narratives. There's going to be a lot of press out there. But I think we might, as we get closer to the election, I think reality might actually be peeking through all of that. And I think that there's sometimes, and it doesn't seem like it, it seems like kind of this couldn't happen, but I think the momentum in Florida might be able to actually combat the narrative. But we'll know more by the middle of the year.
Okay. And you're focused on Florida because it has some of the hotter markets in the country, Miami certainly, but a few others as well. And to my knowledge, correct me if I'm wrong, it has kind of resisted the corrective trends that we've seen in some of the other previously hot markets that actually are seeing price declines, like the Austins of the world and whatnot, right? So are
That's
you
correct.
watching Florida so closely because it's sort of like if that strong market breaks, then all the others are probably even more vulnerable?
Absolutely. Because you have so much speculation there, because you have so much second home ownership, because you actually have a lot of international ownership, this is and it's also one of the largest housing markets along with California and Texas. And so, we saw the trouble in California, we saw the trouble in Texas. I would argue we're not done with the trouble in Texas. It's just still beginning. But Florida has not, to your point, and that's a great point, has not really shown that kind of distress. In fact, if you look at kind of the top 20 list places that we had price declines last year, there was only one or two Florida communities. But when you start hitting places like Miami, which have been featured so much in the news because of things like Ken Griffin going down there with
Mhm.
Citadel, now Jeff Bezos, but when you start seeing distress in those markets, I think it has the power to sort of change the national narrative. And there's a lot of history in Florida. You can read books like Bubble in the Sun or Swamp Peddlers. And in fact, Bubble in the Sun argues that the Great Depression was actually caused because of the speculation on land in Florida.
Really?
And so this is not new to Florida. And what's crazy about when I was there is I spent 2012 and 2013 helping to manage the default crisis down there. So to go back and see speculation in those areas again was just so wild, because you thought it would never happen again.
Well, and that's what I was going to ask this question, but you've kind of preempted it, which is, doesn't Florida have a history of like extreme booms and extreme busts? And to kind of try to paint Florida as like, oh, this bulletproof market, it's kind of like, why would you make that assumption given that every other cycle, in the past 100+ years, it's been a widowmaker for speculators?
Yeah, I keep asking myself those questions every day, Adam. And when I was down there, it's cognitive dissonance to go to these sites. You aren't believing what's in front of your eyes. And then you come back from the road and pretty much, a good amount of people will tell you that you didn't see what you saw and that
So,
you're crazy. So but I mean, some of these places are much worse than what I even saw during the GFC. It's just rampant. Lakewood Ranch, I'll get some hate in the comments for this. Get ready. But they have over 21 communities. I mean, and it's an hour commute from anywhere with a decent job. There's not great cell service. And if they were building affordable homes for, retirees, it'd be one thing, but these things are all overpriced. And they're just building, I mean, miles and miles and miles of these homes with nobody in them. And so that's why we're seeing price cuts there already. But the rate at which inventory is coming online in Florida, it's starting to scare, I think, even, my biggest critics. So,
all right. So, definitely want to get into inventory, and I'm just trying to determine if we should get into it right now. Why don't we follow my little logic here, and then I can
Sure.
toss it out the window if it's not the
Of
right way to
course.
go. I do want to give you a chance to give sort of an update on your travels and what you're seeing, particularly versus what you were seeing, a quarter or two ago on your travels, whether trends are getting better or worse, whatnot. I kind of get the sense from your tone here they're getting worse, but I don't want to put words in your mouth. Um, let's let's start for a second. I'm just going to talk nationally for a moment on these things, and then we'll hit any markets you want to hit. Um, okay, so the market is still pretty much in a standoff around price, right? Like you said, buyers or borrowers have basically said, I'm not doing it right now, right? And I'm curious to hear a little bit more about this, where you think it's maybe not the mortgage rates so much as it's just the prices, right? And you said earlier, I think you made the comment about the narrative trying to be like, well, you might get a good deal this year because rates have come down a bit. And I'm kind of thinking like, if rates have come down from like near 8 to the high 6s, yeah, they're lower, but they're still way higher than they were,
Right.
2 years ago. How is that a
Right.
good deal, right?
Right.
Especially when prices are still as crazy high as they are, right?
Right.
So it's kind of like, that's the like, don't pee on my leg and tell me it's raining kind of thing, right? Um, so nationally, prices haven't really come down that much. I
That's
don't think really at all annually. Last I saw, they had been down like 1% and then they went back up. So we haven't really had a national price correction yet on average, even though certainly some markets are in correction mode. Um, I guess as you look into 2024, what do you see there? Do you think this tension will continue for a while, or at some point, I guess you're saying, uh, maybe the story is going to be inventory, that with more inventory, the game starts to change. But I guess, do you expect an unfreezing, whether up or down, of the current transaction freeze in the markets?
I expect a little bit of thawing this spring.
Okay.
And I will say something I put in my Substack, we look at the Case-Shiller, which is a repeat sell index, or the Freddie index, the same. And that means that you have to use a property that's been sold before, and you put it in pairs to look at home prices. But if you actually look at the median home price for when you include both new and existing, we've come down from the top Q4 2022, about 10%. And then if you actually look at, these are Fred series that I don't ever see in the news, to be honest with you.
Okay. Yeah.
But there's a Fred series that also does the median listing price, which has also come down about almost 9% since 2022. So I believe we've seen some correction in prices, even though we use a very lagging, what gets in the news is a very lagging index that has all kinds of massaging that happens to it. And I don't think it's the best for looking at what's happening right now. But I do think there's going to be a little bit of thawing. I think there is distress. I think we'll talk about this probably later in the show. I think there are shadow markets where these transactions are already happening, but we have no visibility to them. But I see, because I actually look at these markets each week, you just see homes sitting there for, 100 days. And the ones that are selling are the ones that are coming down in price. And you're seeing it all over the country, not just in Florida. So I do think we're going to have a little bit of thawing in the spring. I don't know that that's going to translate necessarily into an increase in a lot of mortgage origination, way more than what people think. But I think you're going to have a lot of activity. And at the same time, Mortgage Bankers Association put out an article last week that mortgage credit is constricting, and it's the lowest level since 2012. And so, while we have this little bit of rates, we also have credit constricting. So the pull through rate of all these new applications, because it's just an application, it's not an approval for credit,
Yep.
is going to be very interesting to see.
Okay. So you anticipate some thawing, and this is multifactorial, so it's really, I understand this is a really hard, puck to call where it's headed. So okay, let's now move on to mortgage rates. So they've come down from their highs of 2023. They're still, as we just said a few seconds ago, they're not affordable, on a
Right.
relative basis. Um, so do you have a strong opinion of where you see them headed in 2024? Will consumers get their wish and rates come back down into the fives and maybe on the way to the fours? And of course, the Fed just sort of surprised everybody by saying it's going to be more dovish than expected. And, 3 rate cuts in 2024. The market's expecting, I think, like 6
6.
plus rate cuts.
Yeah.
So, I mean, all of that could bring mortgage rates down a lot. What do you think?
I think if we're there and they're doing that, there's not going to be a lot of appetite for credit or ability to afford, a mortgage or buy a home. I think if we get to a place where rates actually change kind of, the dynamic and it becomes more affordable, like for instance, Ivy Zellman did a study that if we get to about a 5% mortgage rate, that's where she thinks that the balance comes back to owning versus renting.
Mhm.
I think if rates dropped to the point where you get enough activity on the refinance side and then also make it more affordable, then we're probably in a pretty bad situation at that point. And I don't think that that would then necessarily mean, kind of this gangbuster year for the housing market. I think you would see an uptick in refinances, very similar to the way we did back in 2010, but I don't think it changes the trajectory of where we're going. We are just in such a situation where affordability is so constrained. We've got a long way to go before we really change those dynamics, and rates won't do it alone.
Okay, implying that prices are going to have to play a
That's
role
right.
in that. Okay, all right. I do want to earmark here too that at some point I want to dive for a bit with you into kind of the social implications of today's extreme high unaffordability, especially if that doesn't resolve anytime in the foreseeable future. It's just not a positive thing for a society, especially for younger generations,
Right.
or for older generations hoping to sell their homes to the younger generation at a price they want, right? So we'll dive into that. Okay, so now we get to the really tangled ball of yarn, I think, which is inventory, because there's so many different narratives around inventory. And we might have talked a little bit about this last time you're on the program, but for folks that didn't watch that, maybe we just tackle it afresh here. Does the US truly have an inventory problem here? Is that what's been driving, prices to these levels? Is it really true that we just have too many people and not enough houses? Or is that a false construct?
I think it's a false construct. What we have too much of is speculation in the housing market. And it started, at the end of the last crisis when the GSEs sort of, made it very easy for Wall Street to come in and buy the homes that were in foreclosure, which they then turned into long-term rental. And I think that started, I think as these things go, those institutional investors got involved, and then you sort of had all these fix and flippers and sort of retail wanting to get in on it. And as that was happening, they were doing the fix and flips, doing the, buy, rehab, refinance, rent it out, then go buy the next property. And that was gaining a lot of momentum around 2013, 2014. And so I think what's happened, and then you had short-term rental start, and people were like, wait a minute, I could make $1,500 a month on a long-term rental, or let's say I'm in Nashville proper, I could make, gosh, like $9,000 or $10,000 on a short-term rental. And so then people started transitioning into short-term rental, and
Right.
then,
And sorry, just for folks
oh, go
watching,
ahead.
short-term rental like Airbnb, VRBO, that type of stuff, right?
That's right.
Yeah.
And so, this all started with the idea that people wanted passive income or a way in which to, augment their finances, or maybe they just were sick of working in corporate America like me, where, wages weren't going up. You were doing the jobs of 3 people. Nobody was really investing in productivity. They were doing share buybacks and things like that. And it was a miserable kind of existence working in a corporation. And so I think a lot of people, as COVID began, were looking for alternatives. And then you had COVID, which in many ways broke the social contract for people that had been working at companies for years and they were just let go overnight. And I think everybody realized, well, that could happen to me. And so it just, and people were stuck at home watching YouTube, and they were watching all these videos about how to get rich quick in real estate. And so everybody went out there trying to get theirs, trying to, get one of these homes, either to do long-term rental or short-term rental. And then when they ran out of homes, you essentially had people like contract developers to build specifically these Airbnbs, these short-term rentals. And so, and a lot of that actually wasn't tracked. They were selling these homes on Facebook. And so, the idea that we don't have enough housing for our current population, I just think that is a construct, and it's missing the amount of speculation that has occurred since the end of the last crisis.
All right. Let me re-ask the question then a little bit. Sounds like what I hear you saying is we don't have too few structures.
Right.
Like we actually have the buildings themselves. But speculators now own such a large share of it that they've taken out of the homeowner pool and are now in the rental pool, whether it's long-term or short-term rental. That's just a reality. And I guess the follow-up question is are we at the point where they own so much that they have shrunk the pool available to buy so much that is what is pushing prices up? So that in effect the home buyer is having trouble finding enough options out there because a number of them have been taken off the table.
Yeah, I think absolutely. That's definitely, one of the issues. And I think too, when you get to this point of speculation and mania, there's so much embedded fraud. And so I think things like the FHA program was used by these investors, mom and pop investors, and basically this is what we call non-owner occupancy fraud. But you could basically put down only 3%, take out a mortgage, and then rent it out and get income from it, and say to your originator that you're planning to live there for a year. And so, and we've seen FHA borrowing, for instance, double since the crisis. And so there were all these programs that made it very easy for speculators to get in and start doing this, and low down payment. And so, yeah, I absolutely believe that you had people come in buy these homes for speculation, and it has, uh, led to increases in prices. And the other thing too are the 15 million vacant homes that are not on the market. There are a lot of second homes that the boomers hold. That, I believe there was an article in Newsweek in October. I believe these will be hitting the marketplace over the next several years.
Okay. That's tying into a demographic question I want to get to in a little while too. But I guess first question on this mortgage side. So okay, so we've seen an explosion of speculative capital go into the residential housing market. To a certain extent, there was always investor capital out there, both mom and pop, home landlords. Also companies that were building multifamily and stuff like that, right? And of course, you want some of that, right? I mean, you want companies building apartment buildings and stuff like that.
Yeah.
But now it seems it's really sort of metastasized. And I've railed on this channel in the past about the explosion in institutional money coming into the single family home space, where I really kind of feel like it's got no business being in, right? So you've got these hedge funds that own, thousands or more of houses, oftentimes highly concentrated in certain geographic regions, and that comes with its own risks. And it's also highly unfair in the bidding process for the house, where you get a regular person who's going up against a deep-pocketed, institution that can buy in all cash and can borrow money at much lower rates. They're outbid before it even starts, right?
That's right.
And then you add to that the fact that a lot of boomers didn't downsize, or they downsized, but they didn't sell the previous home because it was appreciating so much. They just wanted to hold on to it, maybe rent it out, treat it more like a stock in their portfolio. Of course, the short-term rental phenomenon has taken a whole bunch more inventory off the market. So I've sort of raised this question of like, geez, do we want to be on the trajectory where more and more of the country is basically faced with no other option but to rent from their corporate, overlord here. And I don't think that's the case. And I've already had some pretty animated debates and discussions on social media, about my aversion to that. And I don't think it should be a full 100% no corporate capital in this space, but there definitely should be some pretty strong guardrails here. One man's opinion. Question to
Mhm.
you is I think I read a little bit about a bill that's been put forth recently to try to get some of this big institutional money, out of the single family home market. But beyond that, like, is the sheriff coming to town? Is anybody watching this at the policy level and saying, at least having a debate of what do we want in terms of the concentration or the allowable concentration of this type of capital in there? Is it even recognized right now as a problem in the halls of power? Is anybody worrying about this, or is just the free market just being allowed to do whatever it wants to here?
Yeah, that's I think that those bills have been proposed. I think you're seeing from some of the candidates, they're already hitting on this topic. RFK Jr. was one really hitting it. I think it's being discussed, but not seriously. I don't I think that, it feels like it's more performance at the moment and people aren't really interested in serious solutions. A lot of people, oh, go ahead.
I was just going to say, is there a conflict of interest here? In other words, like, is there a lot of like lobbying money coming from these agencies that are, have been supporting up a lot of the current politicians? So is this one of those topics where they kind of don't want it to get discussed?
I would imagine, especially with the role of private equity. I mean, and folks like BlackRock, which I think is just an
Mhm.
extension of the government. And so I think, I don't think people are taking it seriously because there's just too much vested interest in the way that it's operating right now. I mean, over the summer, didn't Biden go stay somewhere and the guy was like, "No, this is just an Airbnb. He just rented it from me." And then they realized it wasn't legally registered as a short-term rental. I mean, these are the types of things, the judges, the lawyers, they own these Airbnbs. they they own these investments. And so in our current structure, I don't think there's a lot of political will to strike at the heart of this. And I think honestly, you could probably look at the tax code and really start there to dissuade some of the dynamics we're seeing today. But I don't think it's going to get a lot of traction. I think probably, though, people will talk about it a lot on the campaign trail this year.
Okay. So what I hear you saying is for those that are hoping that like a policy sheriff is going to show up and clean up the town, not coming anytime soon, from what you can tell.
It does not seem so.
Yeah.
Not right now.
Okay. Probably like many things, there won't the political will to tackle this won't emerge until there's a really big problem, like maybe one of these funds that fails and then dumps, hundreds of houses all at the same time on a market and just craters the prices there or something like that.
Right. Yeah. And I think too, though, I think people often exaggerate the amount of ownership they have, these institutionals. And I think really there's a lot more of the kind of mom and pop and retail out there that is going to cause problems first. And we're kind of seeing them implode, some of them already in bankruptcy cases and things
All
like
right.
that.
Well, let me ask you this. So, Airbnb, I saw a stat not that long ago that I think it said something like 50% of all Airbnb properties were bought in the past like 2 years, right? So this was during the mania of coming out of COVID and revenge travel and all that stuff, right? And of course, there are all these get rich overnight, courses, how to become an
Yep.
Airbnb host, in 2 days or less. And a ton of people jumped in because hey, it was easy money, right? I'm gonna, as you were saying earlier, I'll have this asset. It'll kick off 10 grand a month, and isn't that awesome? And now the worm is turned, and a lot of these properties, which I believe, I can't remember the stat, but I heard a stat that said that a good amount of these were bought with adjustable mortgages. So they weren't plunking down 30-year fixed mortgages to get these things. And so you have an increasing number of these properties now morphing from being cash flow producers to, cash flow money pits, right? They're beginning
That's
to
right.
hemorrhage, right? Cash flow.
Yes.
So, and you got a bunch of first-time inexperienced landlords, in the mix now. And so presumably that can't sustain. And at some point, a material amount of those hosts just start liquidating. Like, okay, I thought this thing was going to work, but it's not. I got to stop the bleeding. Let's just sell this thing and be done. And as we talk an awful lot about, housing is priced at the margin, right? And so that type of forced selling amongst that cohort, while people always are quick to tell me, well, there aren't that many Airbnbs relative to the full housing stock. And it's like, they don't have to be. There just need to be
Right.
enough to set the transaction price, right?
Exactly. Exactly. And I think this is already happening to some degree. And so non-QM are the loans that these folks take out, non-qualified mortgages. And they're about 5% of the market, just for everybody's perspective. And those are at a 5.1% delinquency right now. Just to kind of give you some scale, when we went into about Q4 of 2006, overall delinquency was only at about 1.74%.
Oh, okay.
That was Q4 2006. We know what happened after that. But 5.1% of these non-QM loans are delinquent right now. And what's more concerning is the rate of change. Like, delinquency is happening very quickly. And for everybody that wants to say we don't have subprime, they aren't understanding the definition of subprime. Subprime was both non-traditional products as well as lower credit. Well, we have non-traditional products like stated income, bank statement loans, interest only, that you're, kind of adjustable rates, low down payments. Those were kind of the non-traditional products. Then you have subprime, which is FHA. These are borrowers with a 620 credit score, with a 580 credit score, and those are already at 9.75% delinquent, and they are 16% of the mortgage market. So that's
Wow.
21% of the mortgage market that is now way over the delinquency we were in late 2006. And so absolutely this is happening. And I know we'll get to this later as we're talking, but I think that one of the reasons people get to pretend like this isn't a big deal is because of these private notes and these subject to or sub to deals and creative financing that are happening, where I think more of these transacted last year than we know about, because the only way you're going to know about them is you're going to look at county records. There's over 3,000 counties in the country. Some of those records are still, you can get it via fax, and you might have to fill out a form in pencil. But so there, it's just very difficult to know. And then some of these private note sales, they don't record anything at the county. And some of these, what they're called sub two, is sort of the way that they're known. So, I think there's a lot of transacting and distress transacting that's happening, but we have no way to actually know, because they're not going to list anything on the MLS. They're not going to record a sale. This is all happening between private investors.
Okay. So this isn't banks making these loans. These are actual private people, accredited investors, whatever, people with money saying, all right, I'm willing to give this loan to these people. And
Yes.
you're saying these are sort of starting to blow up, but because it's not necessarily publicly registered, we don't really have a view into how bad the bleeding might be.
That's right. And a quick example, when I was on site at a servicer, I was talking to someone where, we're not seeing them in foreclosures yet. I mean, we're seeing a few of them, but just not at scale. But where they're seeing them is in bankruptcies, and investors suddenly realize they're not in first position. Which means that, someone else has taken out, debt on that, and they're before that investor. And
They're a
so
senior creditor to the, yeah.
that's right, because they don't understand title. They don't understand, how we actually show ownership in this country, which is we follow UCC, and that's possession of the physical note. And so there's a lot of pain. There's one Facebook group out there. So for scale, it's hard to know how much of this stuff is, but 12,000 members. I mean, this is not small. And I can tell you so many people have contacted me asking me how they can do it. I know that, this is definitely bigger than what most people think. And there's no way to gauge what's going on with prices in these private transactions.
Okay, gosh, this does sound like a
Hmm.
disaster, waiting to happen. I don't want to be too doom and gloomy about it, but it's got this smell of, from previous cycles where things were opaque and you had new people coming in and providing money, and then, oh my gosh, how did it vaporize, right? We've
Right.
just sort of seen this movie many times
Right.
before.
We
All right,
have.
well, I'm starting to look at the clock and realizing I still got a lot of questions and don't have a ton of time left. So
Yep.
let me get to any update you care to provide about your recent kind of boots on the ground observations. So like I said, the last time we talked, your general observations were, oh, there's more inventory here than is being reported. Um, is that still the main theme? Is it getting better? Is it getting worse? Are there other things that are catching your attention right now?
Yeah, it's getting worse. And and it's shocking to me, Adam, because when I saw what I saw last February, a whole year ago, I thought, awareness was around the corner, because how could you miss this stuff? But I recently went out to Denver. I basically said it's just one big new build site. I mean, and they have negative demographics there. They're building every single spare piece of grass within the city limits, and then way out, 60 miles, 70 miles in the exurbs, massive complexes in the middle of nowhere, plump down into prairie grass, which is highly flammable. At the same time that Colorado insurance rates are going up and taxes. And so, I mean, it's just, it's wild, but it's worse. And then you try to look up those, they're not on the listing sites, especially these new build communities. And what I noticed at the end of the year is that certain builders in particular started pulling all of their listings off of realtor.com, which is what the Fed uses for to track inventory. They were listing on Zillow, and they were listing on their own site. It's still not listing everything, like just a couple of cars, but they were taking it off realtor.com. And, I've asked a lot of people, why would this be happening? And I'm trying to find a reason that, the one reason I think it's happening, which is it's a way to continue to create FOMO, right? If nobody realizes how much inventory is out there.
Mhm.
And some people say maybe it's cost. I'm like, I know where the builders are right now. They have to deliver, they have to sell. I don't think they care about an extra whatever $100 to list it on realtor.com. So it's interesting. I think, kind of to go back to one of your other questions, I think the way that narrative can sort of persist is if people can continue to create this FOMO and continue to, say that there is an inventory shortage.
Okay. Now, when we talked a few months ago, sort of raised the question that, like, okay, I understand that these guys might want to sort of manipulate reality to make things look more scarce than they are, to keep that FOMO going and whatnot. But at some point, they can't just carry all the shadow inventory on their books. They got to make profits. They got to start selling this inventory. And you had said, yeah, at some point it's going to catch up to them. Now that we're several months down the road, I guess I would think, okay, we're maybe closer to that day of reckoning where they have to just start saying, look, we can't carry this stuff anymore. We got to just do whatever we can to get rid of it. Does it look like we're getting closer to that sort of reckoning moment for these developers?
Well, the advertising went crazy at the end of the year. I mean, you saw all kinds of offers, firstborn children, just kidding. But, it was just like, I mean, it was nuts what they were offering. And hey, if you sign up by this date, by end of year, we're going to give you all this money. And so I definitely think they know, they understand, we had 11 months, non-seasonally adjusted of inventory at the end of last month for new builds. So they are going to be doing everything they possibly can to offload, plus probably talking to politicians about how they can pivot some of these communities to affordable housing. So I think that the panic has started, whether they say it to the street or not. But they are doing everything in their power. And of course, the larger national builders are going to have the leg up, and they're going to kill these small private builders. And, I think you're already seeing some of that with some of these small local builders going bankrupt.
All right. Boy, you just mentioned something I hadn't really thought of, but one part of the exit strategy for these guys, these new home builders, is to be able to repurpose a development as affordable housing with the government, where basically the
Absolutely.
government will come in and enable what needs to happen, which is the lower prices to clear the market, right?
That's right.
And of course,
Right.
our tax dollars are going to basically help these speculative home builders kind of avoid the repercussions of their high degree of speculation here, which is frustrating to those of us that are
Yes. And
allergic
yep.
to buyouts or bailouts.
Right. And Lennar has been bailed out before.
So there's
So
precedent. So yeah.
yeah, it's there. And I absolutely think that's probably what will happen, is that the government will subsidize some of their write downs by, using some of these communities for affordable housing, which is going to be horrible for the one couple that bought in there before that happened, right? And suddenly their entire you know, value of their home goes down because now a community is pivoting to a long-term rental, something similar to Section 8.
Yeah. All right. I could
Sorry.
get stuck in a rant there. No, but all right. So look, you mentioned something. Well, actually, before I even get there, let me get back to something you said earlier. Um, you said that the narrative of people being trapped in their mortgages, that factor might not be as big a factor as we've been led to believe. That surprised me because I've kind of taken that as a large grain of salt as to why transactions have dried up, right? Where basically people are just like, I can't sell because if I do, I then got to pay a much higher mortgage and probably trade down quality wise,
Mhm.
right? Buy a lesser place for more, which doesn't feel very good. Um, so help me understand why that's not as big a factor, perhaps, as many of us have thought.
Well, I think we talk about rates on FinTwit and in the financial community, but to your average home buyer, they're looking at prices. And so I think they found two interesting things in the Fannie Mae survey. One was not nearly as many people. So they kind of asked the question, are you planning to stay in your home longer because of the fact that you have this low mortgage rate? And quite a few less said that they were planning to stay longer, or that it impacted their decision. And then for those that did say that, yeah, they think they're going to stay longer, the reasons they gave were things like one of the reasons was because of the low mortgage rate, but almost right there with it was home prices. And then another
Yeah.
was, I just like where I'm living. And so, the way that we hear it in the media, I don't know, you give a number to it, but I'd say, 80% of these folks that have these low, unless they're forced, are going to stay there. And that absolutely is not what they found in the Fannie Mae survey.
All right, that's really interesting. So maybe the seller's death grip on, I'm not going to sell until all this corrects may not be as tight as we thought, right? That's interesting. Look, we haven't even really talked about recession risk and whatnot, and we're probably not going to have enough time, but I
That's fine.
presume a recession risk just sort of makes everything we're talking about worse, right? It makes the gravitational force on prices much stronger. They just have to come down. The struggling, demand from the new builders to sell stuff, that just gets worse, right? I mean, just sort of,
Absolutely.
all
Yeah.
right. You mentioned something else that I've actually talked about this week on social media, and obviously it feel like I really poked a wound for a lot of consumers, which is people's homeowners and rental insurance policies just going to the
Mhm.
moon, right? So I live in California, the state, interestingly, not really that much for the past year or two, but for the couple years prior, really had lots of fire issues. And a lot of insurers are either jacking up insurance policy prices now in response to that, or leaving the state entirely. And I had my policy dropped by State Farm, and really inelegantly dropped. Like literally just sort of called me like, hey, in 48 hours, your policy is not going to be
Wow.
enacted anymore, and good luck, like not even like, hey, go over to these guys who are still providing coverage, right? Just summarily like, we're out of here. And so I asked on Twitter, hey, who else has seen a big jump like this or even getting dropped? And the deluge of responses that have come back was shocking even to me. And it's one of the things I noted is it's everywhere.
It's
It's
everywhere.
from California to Florida to the heartland, and just gargantuan increases. Some people seeing 20, 30% year over year, but other people saying like, yeah, in the past, 2 years, it's tripled, right? I mean, there've been some cases that were,
Mm.
I have even a hard time believing, where it was like it quintupled within a year. I mean, just
Right.
it's
Right.
bananas. And I think maybe part of it is because home prices have increased so much, and now the insurance companies are like, well, we get to rewrite our policies to match how much more expensive houses are now. But then there's also all sorts of talks about, whether it's climate change driven or not. We have, the rebuilding costs in a lot of areas has gotten a lot higher. And again, that's probably inflation. A lot of key inputs have gone in, wages and materials. So obviously, this is something that puts just a lot more downward pressure on prices, right? All things being equal, it just costs a lot more now to insure these
Absolutely.
houses. And if the gains and policy prices keep increasing like this, I don't get the sense that this is a one-time deal and that looking forward, they're going to be flat the next decade. They're probably going to continue. And I'm sure there's all sorts of other related costs around housing like this. So uh, let me know anything you care to say about all this, but it seems like this is
Yeah.
a really material new factor that really hasn't been a huge part of the discussion until recently.
So just I wrote an article about it in October of 2022, I believe. Like I'm trying to remember. So it was a year ago. No, sorry, October 23. I wrote an article about it. No, it was 22. Sorry.
Yeah.
But it was over
So
a
a year
year
plus,
ago.
yeah.
Yeah, yeah, exactly. A year plus ago, right after Ian, because this was already happening down in Florida, and I wrote it for an industry magazine. And, my question was, what is a home worth that can't be insured? And
Hmm.
so it's another one of those cases where this just isn't something anybody wants to talk about until they're faced with it. And because, I was trying to talk to people about it. We get a lot of hate when I talked on Twitter about it. And then the insurance increases came, and everybody now is just in total shock. And that's one of the reasons why I'm looking at Florida, because they've been impacted. They already had their insurance was 4 times the national average. So it was already a bad situation down there. There were already people in the Keys that couldn't get insured. But now it's just, it's impacting everybody, just like you say, Adam. And I hear a lot about that. It's because the insurance companies can't get reinsurance and things like that. They can't really hedge the risk. But yeah, this is a massive factor. And of course, if the home's more valuable, it costs more to replace it. So I think this is going to be one of those things I talk about on Twitter a lot. Property taxes and insurance aren't sexy, but this could take, the entire market down with these costs where they are, and the taxes increasing as well at the same time. And a lot of the borrowers that are in distress, it's because of the big increases in their tax payments, especially those that bought like last year or the year before, because they get the supplemental tax where you are in Adam. In California, and they don't realize, the lenders don't do a great job of telling them, hey, yeah, this is what taxes were last year, but your taxes next year are going to be based on a current assessment. And they get hit with that bill about a year after that origination. And most of them have forgotten by that point. It's
Yeah.
nuts.
It's just
So
nuts. So, all right, we're going to go a little bit long here, if that's okay
that's
with you,
okay.
because there's just so many key
Yeah.
questions we haven't gotten to yet. And sorry, my computer was making a couple of noises when you were talking there. And the reason for that is I was trying to
Oh,
pull up this article that sadly just looks like it's got um, a bunch of like auto playing ads in it. But let me see if I can pull it up here and not generate the ad. So here's an article from Fox Business. that says the old American dream died. Realtor details salary needed to buy a home, afford a middle-class life in 2024. And then here the subline, we have a cycle keeping people out of the middle class, realtor says. Okay, so when you talk about narrative, I find that really interesting because I think that realtor is giving voice to a lot of the pain that a lot of Americans are feeling right now for all the reasons we've been talking about. And the fact that it's a realtor saying it is crazy. Right? I mean, they're basically the last people you would expect to say anything negative because they just want to get you into a darn house, right? And so if we're seeing cracks like that, where, okay, mainstream media source, realtor, beginning to actually sort of say like, look, we've got this housing market that just like really doesn't work for folks. And I can't remember the latest stat I saw on this, but the number of people, well, I know in California, it was like the number of people that can buy the average house in California, it's like maybe 15%, right? And I think nationally, it's probably not that bad, but it's probably not a hell of a lot better, right? So how do we begin to exist in this country where like the median person like doesn't even have a hope of buying a home?
Yeah, and I think you know that I just believe we can't. I mean, and it's just gotten so unaffordable, and because there's so much. I mean, housing is anywhere from 12 to 18% of GDP, and when you don't have, when most Americans can't participate in it, I believe that there's a limit to how many houses the top 20% are going to buy, and even if you're an institutional investor, you're smarter about your money right now, that this isn't going to be a great investment, especially as we're seeing rents decrease. But the realtors and the loan officers are getting on this issue because what's been happening in places where you are, Adam, and in Florida, is they'll get right down to, ready to originate that loan. And you have to have, if you're getting a mortgage, you have to have insurance. And all of a sudden, the property can't get insured. And deals are falling through, and that's why you're seeing a realtor be like, this can't work, because they're losing out on sales, because of the insurance issue.
All right, so here's like where my brain gets stuck often is like we talk about all these institutional, landlords, all this money coming into the single family home market, right? And it's not a super easy market to be in, right? Like you got to be a landlord, things break, it's messy, right? And yeah, when prices are shooting the moon year after year, like housing was for, the past 5 years plus, well, for hit a nice tailwind at its back for a couple of decades now, but certainly leading up to last year, it was going gangbusters, right? But once it stops, and maybe the prospects going forward become less sanguine, and maybe you're beginning to get worried about, markets going down or whatnot, and interest rates get as high as they have become, right? It begins to look a lot more appealing to be like, well, if I've got marginal money, why would I put that in another housing unit? Why wouldn't I just park that and get a nice, safe return? And I think Nick Jurley had some stats he showed me a few months ago that basically showed the all-in return of being a landlord on average, and interest rates yields, and the yields had surpassed it, right? So it's like,
Yeah,
even if they're close, it becomes
that's
really
right.
tempting just to take the money and run, just put it in the T-bills
Absolutely.
and collect your check, right? And not have any midnight calls about broken toilets and stuff
Absolutely.
like that, right?
Yep.
So we got that on one side where I'm just kind of like, how much longer are these guys going to resist that comparison, right? And then secondly, like, if people are really having trouble buying all this inventory like we're talking about, then there's tens of millions of depreciating wooden boxes across America, right? I mean, just the more time goes on, those
Oh,
things are worth less with just their embedded value, right? Like, so to a certain extent, prices have to come down because of that if people can't step up and buy them, right? To maintain
that's
them.
that's right. And that's why, again, Florida is one of the epicenters, because all those empty homes are sitting down there with cracks, getting mold. Nobody's watching these. I mean, and there are so many empty homes. And of course, then depreciating in value. And now we're also seeing all of these, lawsuits against the builders for shoddy building. I mean, this is cropping up everywhere. And I shared a chart on Twitter just the other day about how claims have increased, builder, claims against the builders for repairs. And so absolutely, these assets are starting to depreciate. And I was going to say, the institutionals, when a home is worth more, the only time that's good is if they can get cheap money, right? But when it's worth more, and they can't get cheap money, then that's not an asset to them. It's depreciating, and it's not as valuable. And so much of our system is on the idea of collateral and what we can pledge to get cheap money. And when there's not a lot of cheap money, then that collateral is just not as valuable anymore.
That's a great point. All right. Well, there's a lot of my questions here. I'm just going to jettison until the next time you're on here. Let me ask this high level one, and then we'll get to for just a couple of minutes at least, sort of talk about some of these interesting solutions or at least tactics that purchasers are taking right now. So obviously, Melody, I get from you a lot of concern over the distorted, I'll say the deformed state of the U.S. housing market, right? That prices do not seem to be aligned with sustainable long-term value, right? What do you think it's going to take, just brass tacks, to bring this market into alignment? You talked about lower rates, you talked about lower prices. Like, end of the day, what are we looking at here that needs to bring this thing back into balance price-wise? 15% decline, 30% decline, 50% decline, just sort of finger to the wind. I know you're not saying it's going to happen this year.
Right. I'm not.
Yeah.
But I think overall, the path I see ahead for the next several years, probably it's at least a 30% drop. And in some markets, it's going to exceed the 50% mark, especially in these places where it's questionable about the quality of life living there. And now when you can't even get insurance, and all your other, I do believe we're going to have some significant corrections in some of these markets where it is just way too unaffordable for the regular American.
All right. Okay. Well, it's going to be very interesting to track this over the coming years, Melody, and I really hope that you'll keep coming back on here and keeping us updated.
Of course.
All right. So to put a little, hopefully positivity, but at least just to inject something a little bit different here. You and I have had a couple of private conversations about, some interesting things that we're looking at that people who want to transact, but not necessarily at today's prices, where they're sort of finding ways to do so in this era of record high unaffordability and very high mortgage rates. So I think there's one or two that you've looked at, and then there's one that I put on your radar. I mean, I know it was already on your radar, but when I asked you about it, and we'll talk about that in a few seconds. So what are you seeing out there?
Yeah, so I'll start quickly with sort of the private note space that I was talking about earlier. And, there's just a lot of activity going on where essentially people, just a regular investor out there, is purchasing a note or creating a note and doing private lending. They may involve, if they do a ton of transactions, they may involve an originator. But put it this way, there's big conferences around this, there's Facebook groups, and I've had several people contact me, but it's called creative financing. And I think there's a lot of above board people that are doing it. They're like auctioning certain notes, very responsible, want to do it to try to maybe help borrowers that might come into a bad situation where maybe they're going into bankruptcy, they can't afford it. And so essentially they're going to that borrower in delinquency and say, hey, listen, I'll take over your mortgage payments, essentially, and you're going to sell the house to me, and I'll pay the mortgage. And typically what they do is then go find an investor to pay them and buy that actual mortgage out from under them. But in reality, until they pay off the mortgage, it's still in that borrower's name. And so what will happen is that borrower will be taken to foreclosure if that investor doesn't make those payments as they've promised, and could impact their credit. So there's a bunch of this type of creative financing out there. And then that sub two that I talked to you about, that's kind of where they do that. And they really try to kind of, they're not evaluated for their credit, et cetera. Instead, they just assume, but they're not doing a mortgage assumption, but they take on those payments. And even if things are recorded with the county, the way that we prove legal standing or ownership in this country is through possession of that note. And who owns that, who has that note is actually going to be the bank, or if it's a Fannie Freddie loan, they have actual possession of that note. And so there's a potential for a lot of really ugly situations out there where perhaps if you were trying, you came into trouble and you're like, hey, somebody contacted me, they seem legit. They're going to take over my mortgage payment. They're also going to give me like $5,000 or are going to give me my equity. But then what happens when that person can't find an investor to pay off the loan? They're stuck with it. And if they can't pay their taxes or insurance, often, the borrower is essentially going to be the one that gets taken to foreclosure. That's going to be a very, unfortunate side of that. But this has become a lot bigger than I think most people think.
Realize. Okay, so this isn't necessarily a good thing, although of course, if you're one of these sort of distressed homeowners or distressed borrowers, it's helpful because it's letting you stay in your house, right? And presumably these people that are issuing the private notes are getting enough of a return that it's of interest to them to do this. But it sounds like you're saying lots of ways for this to get into trouble.
Yeah, and I'm all about the private marketplace. I really am. But I also know how complicated this is. And I know that some of the big players shouldn't even be participating because they don't understand how complicated it is. And so I can see some of the trouble ahead. But I do think there is a marketplace for private note sales if it's done responsibly. But
Yeah,
there's also a lot of ways for it to go wrong.
right. But it sounds like you're saying right now it's kind of Wild Westy.
Correct. Yes,
All right.
absolutely.
And is it pretty much only being made to distressed homeowners, or are there opportunities for somebody who's got good credit just to get a better deal on a private note than, say, from a regular bank?
Yeah, I think when interest rates are like this, that could be the case. I've read a bunch of examples of like somebody, their parents gave them a home, they had a home, they just wanted to get rid of it. It wasn't really worth it. Give them quick $14,000, whatever. I mean, there's certain cases where I think it just makes sense and it's not about default, but how most of these folks find those are through looking on county records for people that are behind in their taxes are delinquent. And so it is typically the strategy is to look for delinquent borrowers.
Okay. Yeah, and obviously with these things, when you're a delinquent borrower and somebody comes to you with a good deal, yeah, it may feel like a lifeline, but it may at the end of the day not really be the world's best deal for you. And obviously, a delinquent borrower in these situations, they're riskier, and therefore, many more things can go wrong, like you're saying. So I'm going to
Correct.
kind of
Yep.
park this as a creative solution that is happening, but one that comes at quite high risk. Now, the thing that I called you about the other day, which maybe we can just talk about for a minute here, is, it's always sort of intrigued me, this idea of assumable mortgages, right? Where if
Hmm.
somebody has a great mortgage, and you're buying their house, boy, wouldn't it be great if you could get their mortgage, right? Have the mortgage transferred to you.
Absolutely.
And in a high interest rate environment, well, geez, that just becomes super appealing, right? If this person's
Absolutely.
sitting on a 3% or sub 3 mortgage, and you'd have to go get one near 7, gosh, wouldn't you rather just buy their house and assume their mortgage, right? And I
Absolutely.
know it's not super easy. There's a lot of factors that come into play, but it's been a thing. And I've wondered
Hmm.
for a long time about, well, gosh, how do you get in on this, right? And I stumbled across this company. This is no way, folks, any endorsement. I'm just mentioning it so you can check it out on your own. Company's called Rome. I think their website's withrome.com. And basically what they've done, I just find interesting, which is they have created an exchange where you can go to these markets that they're in and find properties with current sellers who are willing to let their mortgage be assumed. So you go and you look at a listing and it tells you, what their current mortgage is at and all that type of stuff. And they're removing a lot of the friction for you by doing that, because otherwise to
Right.
go and figure out which homes have an assumable mortgage and which
Right.
which guy's looking to sell and is he willing to do this, right?
Right.
It's very hard for the average person to figure
Absolutely.
out. And I guess there's a lot of paperwork and stuff, additional paperwork you have to do with an assumable mortgage, and this company helps you with that too. So they kind of hold your hand all the way through the process. Now, again, I'm not endorsing this particular company. I just think it's sort of interesting that people are saying, oh, interest rates are so high, I'm going to try to find a side door. Oh, assumable mortgage. Well, that makes a lot of sense, right? So you're kind of nodding as I'm
Absolutely.
saying this. We've talked enough for me to know that you don't necessarily say this is the best thing since sliced bread, but that it is a credible, interesting alternative to think about when presented with it.
Absolutely. And I like the more traditional route where someone is assuming the obligation, and part of what Rome does and part of this process is you release that borrower from that obligation. And I think that's really critical, and the difference between what's happening in this sort of shadow market in some of these deals. And so I honestly think it's a great idea, because the thing about anytime you transact with the agencies, and right now the majority of these are FHA, VA, and USDA, it can be unbelievably complicated to figure out what you're supposed to do. And I can tell you the most servicers don't even know what you're supposed to do. And because you have to fully sort of underwrite the file, you also need a connection with an originator. And so some of the servicers today don't necessarily have that, although in order to service FHA VA loans, they need to have kind of those relationships set up. And so, I think it's a really good idea, and honestly, to give people a marketplace where they could look this up in their area and then help them through the process. And as long as the fees are reasonable. But one thing I've seen inside the industry, a recent article 2 days ago, is that the servicers were complaining that basically this, because it's re-underwriting the entire file for the most part, some cases where that's not true, but typically yes,
Mhm.
they can't charge a fee high enough to make it, to basically pay for their own effort, just because the way the fee schedules have been set up. And this is with VA specifically. But I definitely think this is an alternative. And I think in 2017, Fannie and Freddie started offering it as an alternative for default loans, which is a different situation. But to me, at any time you make this crazy world of mortgage easier for the regular consumer, I'm a fan of that because it is so complicated. And if, why not let someone take advantage of that was going to go out and get a mortgage? I mean, it makes perfect sense to me.
Well, that's what's so interesting to me about this. And again, folks, I'm not endorsing this model. I'm
Right.
certainly not endorsing this company, but uh, the housing market is fraught with all of these affordability issues that Melody and I just spent the past hour railing about. But is one of the great things about capitalism is when a problem becomes big enough, when allowed to, the free market can start finding really interesting, innovative new ways to start servicing need. And hopefully that's what we're sort of starting to see here, which is as dire and depressing as it seems like the housing market has gotten nationally. Maybe this is the time where these are the pressures that then create the new diamonds of the future, right? So
Right.
anyways, I don't want to oversell this, but it does give me, this is one of the areas that gives me a little bit of glimmer of hope that, okay, there might be better ways of doing this. And of course, we've railed in the past, Melody, about how the housing sector is run like a cartel, right? The realtors protect all their information, very cartel-like. Same thing with the lenders and everything about this. So
Title
anything
companies.
that
Yeah.
that creates a fissure in the wall of the cartel and lets sort of new innovation happen in a way that's good for the consumer, I'm all for. Sounds like you are too.
Same. I am as
All right.
well, especially with these crazy requirements. Yeah.
All right. Well, thanks for going along with me again. I've got a bunch more questions that we'll just have to save for the next time you come here. Very important question before I get to the very last one, which is for people that have really enjoyed this discussion, Melody, and would like to follow you in your work, where should they go?
They can find me on X Twitter at M3_Melody, at M3Melody Substack, and M3Melody YouTube. Um, that's where I try to write a Substack every week or 2 weeks and a YouTube video at the same frequency.
All right, awesome. Well, Melody, when I edit this, I will put the URLs to those up on the
Thanks.
screen. Folks will also put them down in the description as well. So if you want to get one-click access to those, that's where they'll be. All right, I've got just a couple little quick house cleaning things to mention here for folks. And then I'm going to ask you the very last question, Melody, which is going to be, we've just been talking about housing and financially related topics, this whole discussion. What's one non-money related investment you'd encourage folks to develop? So think about your answer to that while I just go through the next 30 seconds. So just want to remind folks that we have locked in a date for the Thoughtful Money Spring Conference. That's going to be Saturday, March 16th. I think in my video with Lance, I mistakenly said the 18th. It is the 16th. More details to be coming very soon on that. But again, make sure you mark your calendars for that. A reminder that my Substack, adamtaggart.substack.com, not only do I publish a lot of free information there during the week about everything that's going on at Thoughtful Money, but if you become a premium member there, in addition to the other benefits, it acts as sort of like a discount card for you for things like the conference. So we're going to have pretty substantial price discounts for the people that sign up early bird discounts. You will get an additional substantial discount on top of that if you're a premium subscriber. So just want to let you know about that additional benefit. If you've enjoyed having Melody on here, would like to have her come back on again, hopefully maybe in Q2 to give us an update on where she sees the housing market, or even sooner, if there's anything major that really catches her attention, please let her know that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. All right, Melody, as we land the plane here, let's get to that question about what non-money related investment would you encourage folks to consider adopting in their lives?
Yeah, so I really enjoyed Steph Pomboy's answer, and I think I'll just kind of build off that in terms of, I think what we have not been investing in is our relationships, our in real life relationships. I think a lot of us spend a lot of time with our not in real life relationships, but I just think that, one non-financial investment would just be in the time that you spend locally. Because, I talk about housing, and I think one of the reasons that, housing has become a casino is that people don't care enough about where they live. They don't care about their neighbor. We don't spend a lot of time with our neighbors anymore. We're all focused on just our thing. And so I think investing time in getting to know your neighbors, investing time to getting to know your city council, to really care about these things and understand what's going on locally, and sort of maybe fight these things locally, like Wall Street coming into your city, buying up your homes. They're going to have hearings on that. Go to the hearings. So that would be probably what I would recommend to everyone, because I feel like we're going to be going into a very tumultuous time this year, because of all these elections across the world. And I personally want to have a great support network. And I also want to fight some of these trends, like the institutionals coming in and buying up homes.
It's a great point. I totally agree with all of it. Real estate, they always say location, 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 right? I would say life is location, 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 because that's where you're building your roots. That's where you're building your community relationships. So obviously, the more you make that a focus, the higher the probability of getting the type of returns you want on it. And you raise a good point. Like, I'm curious of people watching here, how many of you can name anybody, one person on your city or town council? How many of you have ever been to one of those meetings, right? How many of you have been there and made your voice heard on a particular proposal or project or initiative or whatnot, right? I'm willing to bet that number is pretty low. I'm going to bet it's probably in the single digits. And I would put myself on the list there of folks that don't know nearly as much as they probably should about their local governance, right? There's lots of things I do to try to stay involved and make a difference, but there's a lot more that I could be doing if I'm really being honest about this. I talk a lot about the individual helping themselves first. It's kind of like the airplane, put on your safety mask first before you help the people next to you. And the hope for that is that we ultimately drive change at the top by getting individuals to live their values, then demand that of their elected officials, and it just sort of like percolates up, right? But you can't just end it changing your behavior. You've really got to get out there and argue and nurture the change that you want to see in the world, and that means being really involved at the local level. So anyways, thank you for emphasizing that, and given your position there in real estate, it's very fitting for you. So thanks. All right. Well, Melody, I love having you on the channel. I always appreciate this discussions. The door is open to come back on anytime you like. Folks, if you've got any stamina left in you, the video that just launched before this one is with Dave Bianco. And, you know, Dave is a very smart guy and is never short of strong opinions. So if you want to hear that one, I'll put up a link to it right here. Melody, thank you so much again. Everybody else, thanks so much for watching.